Hi, and welcome to Chapter 11. Okay, so what is responsibility accounting systems? What does that mean to us? Well, responsibility means being held accountable for your actions. So, what we're going to be looking at briefly here in Chapter 11 is how organizations can hold managers accountable for their decisions and for the results of their decisions. And the first thing we're looking at here is something called decentralization. If you're not familiar with the term, you might want to go and look it up. But essentially, what it means is all decisions maybe shouldn't be made from the folks in the 14th floor corner offices of the corporation. That maybe we need to give some of that decision making power to people lower on the totem pole. So, benefits of decentralization: top management freed to concentrate on strategy. And that's really what you want your C-suite people to be doing. They should be looking out 5, 10 years down the road to make sure that the company is going to a direction that's going to be successful. Lower level decisions often based on better information. Obviously, if you're sitting in an office on the 14th floor, how much do you really know about the nuts and bolts, the nitty gritty work that's being done in the organization? Not a whole lot. It's better if some decisions are made by the people who are down there working in it. Lower level managers can respond quickly to customers. I relate that always to customer service calls. How many times have you called a company for customer service on a purchase you made, and it's 10 minutes going through several different layers of people in order to get a decision made? Lower level managers gain experience in decision making, and decision making authority leads to job satisfaction. If you allow lower level managers to make decisions, you're creating the leaders of the future for the company, so that you can be promoting people internally rather than looking outside the company to find leaders. Disadvantages, of course, if there are advantages, there are disadvantages. Lower level managers typically aren't included in decisions about strategic planning. So their decisions on the lower levels may not be they may not work well with what the organization is planning long term. Maybe a lack of coordination among autonomous managers. I certainly saw that at a company I worked for several years ago. It was an engineering firm. They did about $125 million a year, had 23 offices. And the office in Las Vegas, we found out, the website was actually totally different than the corporate website and what was being done in other offices to kind of keep us all together as one organization. They were rogue. The manager at that particular office decided that was his business and he was going to run it the way he wanted. That's one of the downsides of decentralization. Lower level managers' objectives may not be those of the organization. That's self-explanatory. It kind of goes back to one of the positives that we looked at. And it may be difficult to spread innovative ideas in the organization. And this is something that we've talked about periodically during the semester. The fact that when you try to do something new in an organization, unless you have complete buy-in, it's difficult to get it actually established. Responsibility accounting. Managers are held responsible for those items and only those items that the manager can actually control to a significant extent. I had that argument with project managers at an architectural firm. I was the controller there for 10 years. And I'd sit down monthly with budgeted versus actual reports and go over them with the project architects. And they would sometimes look at those budgeted reports and say, but why am I being held responsible for rent and utilities and all these other overhead costs when I have no control over them? They're affecting the profitability of my project, but I can't do anything about them. And that was actually very true. And I removed that stuff from their reports in the future. A responsibility center is used for any part of an organization whose manager has control over and is accountable for cost, profit, or investments. So responsibility. I was responsible for the accounting department in my entire career. So the expenses that came out of the accounting department were mine. The definition of a cost center, and that was accounting, a segment whose manager has control over costs, but not over revenues or investment funds. So I had control over the costs of my department. Technically, I had no revenues, but in actuality, the information that we created and the reports that we analyzed brought forward savings that increased the bottom line profit. So in a sense, we were something of a revenue source. A profit center, a segment whose manager has control over both costs and revenues, but no control over investment funds. So this would be a department in a corporation. I worked for an engineering firm, and we had profit centers, which were essentially project areas. So the projects had revenues and expenses, but they were in the corporate office. So there were no investments that they were in control of. Now, an investment center is like that Las Vegas guy I was talking about, because he had control over costs and revenues from the projects that were being done by his office. He was also responsible for the investments in assets that were put into the office in order to create that revenue. All right, we've all heard the term return on investment, ROI, but think about whether or not you really understood the definition of ROI. And what we're looking at here is we have a definition that says take the operating income, not the net income, the operating income, and divide that by the average operating assets. So operating assets are things that are used to create revenue. So they're listing here cash, accounts receivable, inventory, plant and equipment, all that sort of stuff. So what we're saying here is, here are the profits created by those operating assets, and here's the investment. So what return are we getting on this investment? Most companies use the net book value of depreciable assets, and we'll remember from Chapter 8 in 201, book value is the cost on the books minus the accumulated depreciation. So here's our definition for ROI. Our definition for margin is to take the net operating income divided by sales. And our definition for turnover is sales divided by average operating assets. So in essence, we can change this definition to this definition. Margin times turnover. Because if we take that, if we put this times this, we get rid of the similar numerator and denominator. We get net operating income over average operating assets. So how do we increase ROI? Regal reports the following. So we're given this data: net operating income, average operating assets, sales, and operating expenses. So you can see from our definition, we need those numbers. So we take net operating income, which is $30,000, divided by sales of $500, times the $500,000 in sales divided by the average operating assets of $200. So our ROI is 30 over 500 is 6%. 500 over 200 is 2.5. 6% times 2.5 is 15%. That's our return on investment. We're getting a 15% return on our investment in the assets that we have. Assume that Regal's manager invests in a $30,000 piece of equipment that increases sales by $35,000 while increasing operating expenses by $15,000. This is something that companies do all the time. If we do this and this and this, how will it affect our net operating income. So we're saying $30,000 piece of equipment, so our average operating assets now are going up to $230,000. Increased sales by 35, so sales are now going from 500 to 535. Increasing operating expenses, so they're going from 470 to 485. So what happened to our ROI with these assumptions? Well, we now have 9.35% times 2.33, 21.8. So we've increased ROI by a full 6.8 percentage points. Does it sound like a good thing? Think about it. All right, so criticisms of ROI. ROI in the absence of the balanced scorecard, which we're going to talk about in the next chapter, management may not know how to increase ROI. So the idea is, how do we figure out what's going to increase it? Managers often inherit many committed costs over which they have no control. This is something that presidents see. President A makes certain commitments to spend money on this, this, and this. The next president has no control over that. It's already done. It's baked into the pie. Managers evaluated on ROI may reject profitable investment opportunities. And that's where we're going to kind of look at ROI and something else. Residual income, net operating income above a minimum return on operating assets. So what this says is there is an assumption here that the company is required to return a minimum percentage on the operating assets. So residual income is going to be defined as net operating income minus average operating assets times the required rate of return. The required rate of return is a lot of times simply going to be, what do we have to pay to borrow the money in order to make the investment in the assets? This computation differs from ROI because ROI measures net operating income and earned relative to the investment in average operating assets. This is doing net operating income earned less the minimum required rate of return. The retail division of Zephyr has average operating assets of $100,000 and is required to earn a return of 20%. So what's the required rate of return on this investment? 20% of $100,000 is 20%. If the division earns $30,000, they have a $10,000 residual income. Minimum required return is 20. The actual income was 30. And that kind of takes us to the end of chapter 11. I told you it was brief. Once again, we're coming towards the end of the semester, so let's really buckle down and get everything done on time. Please, I am begging you, come and ask me if you have any questions. If you need any help, I am here to do that for you. And I'll see you in the next video.